Hey guys, Ken Calcutt here with Cornerstone Financial Management. Hope you're having a great fall. Today is October 22nd. I want to give you guys a market update. It's been a little while since we did a market update, and I also want to cover one topic that I think is important for a lot of people saving for retirement. So quickly, we'll dive into a market update here. This is the S&P 500 chart, what we look at in most of these videos. You can see we're up here today. We're bumping into all-time highs right now. We had our April low back here, and we've had a long run since. So very strong market for a little over 6 months now. The economic setup, in my opinion, is still solid. Economic growth is good. Interest rates are generally trending lower. Fiscal stimulus is still going on within the economy. A lot of good factors that would lead us to believe stock market should continue to climb higher. Now with that, I would not be surprised if we see a drop. 5 or 10% would be a very healthy correction to the stock market. We kind of need those corrections periodically. So if we dropped, let's say the S&P dropped to 6,400 or 6,100, that would not be problematic in my opinion. We're currently around 6,700. So if you see little drops here in the next 90 days, I don't think that's much to be worried about. It's probably a healthy correction, and we probably move forward from there and move higher. So I'm pretty optimistic about the market, but I am a little concerned simply because it's run straight up for 6 months. That needs to slow down, but overall, very good. I'm gonna pivot here and talk about a topic in retirement savings that I think is really helpful for everyone. Okay, so this is a concept a lot of you are familiar with. It's called 401k catch-up contributions, all right? And with the big, beautiful bill that was passed this year, there's some changes to catch-up contributions that actually might affect you this year and certainly will affect you in 2026 going forward, if you're age 50 and older and trying to maximum funding in your 401k, all right? So some highlights here I think will be helpful. If you're age 50 and older in 2025, you're allowed to do your normal 401k funding, which I believe is $23,500. You can do an additional $7,500 in catch-up contributions if you're 50 and older. There's a new rule that got rolled out in the big, beautiful bill that does apply to this year. I don't understand why this is what it is, but this is the rule. If you're turning age 60, 61, 62, or 63 in 2025, if you were born in the 4 years that would have you turning these ages in 2025, your catch-up contribution could possibly be as high as $11,250, not $7,500, okay? I don't know why they chose these ages, but they have a special catch-up contribution if you're 60, 61, 62, or 63. $11,500, but your 401k plan at work has to allow it. Not all of them do. Most of them probably don't, because this is a brand new rule. Most 401k plans don't update their provisions that quickly. I would suspect we'll see this more prevalent or more relevant in 2026, but it's possible this year. So if you're max funding your 401k and you're 60 to 63 in 2025, and this is appealing to you, say, hey, I'd like to put a little bit more in this last quarter, check with your 401k provider, see if they've updated the plan provisions to allow for this, what they call the super catch-up for ages 60 to 63. You could do an additional almost $4,000 more than the normal catch-up. So new rule that's rolled out, that'll be the case going forward each year. It'll be indexed to inflation, so it'll be a little higher than 11.2 next year. One more thing to look at here. Starting in 2026, not 2025, 2026, if you're doing catch-up contributions, not the super catch-up, but just normal catch-up contributions, age 50 and older, those catch-up contributions must be Roth contributions. They cannot be pre-tax contributions if your income at that job is $145,000 or higher for 2025, for the prior year. All right, I know that's a little confusing, but if your 2025 income at your current job where you fund your 401k is 145 or higher, and you plan to do catch-up contributions in your 401k in 2026, those catch-up contributions must be Roth contributions. They cannot be pre-tax contributions. Now your basic contributions up to the 23.5, that can be pre-tax. If you do the catch-up, it has to be Roth if your income is over 145. This is not household income. This is your personal income at that job, okay? So very specific rules around this one. A lot of people are trying to max fund their 401ks. A lot of people are doing their catch-ups. These new rules are gonna make it more complicated. So I think this will be helpful for you as you're planning out, how do I max fund my 401k under these new rules? These are some provisions that you need to know. So super catch-up might be allowed. Catch-up contributions, if you're over 145, must be Roth starting next year. Hopefully that's helpful for you guys. I know it's complicated. Tax laws always are. But hopefully this is helpful for you to understand what you're dealing with in these new rules. As always, if we can help clarify things for you, reach out to us anytime. Thank you.